in general, people tend to underprice a lot. I think this is deep tech and traditional tech. I think most people feel self-conscious or like guilty asking for more money. And I remember doing a survey a few years after Susa Ventures started of some of our portfolio companies. It was like a really short pricing survey. And the question was basically, what do you charge today for the same product that you had when you launched? How does that compare to what you charged when you launched? On average, I think companies charge something like 4 or 5x more today for the same product. And it wasn't necessarily that the product got better. It was more like everyone kind of underpriced by 80% on day one. And then it took them a while to figure out, hey, when I sell this to people and I tell them it's $5,000 or $20,000 and they immediately sign, maybe that means I'm undercharging. So I think that's one anecdote, right? Which is, it's hard to internalize because even knowing this, people still underprice. But knowing that most people underprice by like 2, 3, 4, 5x, maybe that's a good starting point, right? Like whatever you're going to charge, could you just double it?
Hundreds of thousands of researchers around the world are working to improve life and address imminent threats to humanity. Often their research ends up in the scientific valley of death in the form of publications and patents that never see the light of day. That is about to change. Welcome to the Lab to Startup podcast, hosted by Naresh Sunkara, founder and executive director of the Berkeley Postdoc Entrepreneurship Program at the University of California, Berkeley. This show has two main goals: share the stories of those who have successfully founded startups based on their own research, and highlight resources needed to help those aspiring to launch startups in the deep tech space. Whether it's electric cars, vaccines, addressing climate change concerns, or possibly establishing life on other planets, Naresh and his esteemed guests want to help scientists, engineers, faculty, and researchers bring their innovations to market. Learn more and subscribe today at labtostartup.com. And now, here's Naresh.
My guest today is Leo Polovets, the co-founder and general partner at Susa Ventures. Leo focuses on enterprise software and technical products at Susa. About 2 years ago, he also started Humba Ventures, a fund that invests in deep tech and critical national sectors like energy and defense. I've known Leo for a long time, since I pitched my first startup to him over 10 years ago. And even though he didn't invest, he was one of the very few investors who bothered to offer feedback, which was very helpful. And I have a huge respect for such investors. We've stayed in touch since then, and I'm super excited to have him on my show today. We are exclusively going to focus on his deep tech investment thesis and all the lessons learned in the space. I hope you find this conversation very useful. All right, Leo, thank you for joining me today. A section of my listeners are grad students and postdocs who are considering launching startups, and many of them are early stage founders. So I thought a good place to start this conversation would be to talk about a few things from your recent presentation that you posted online, exploring startup ideas. Let's talk about the ideas one should work on.
That's a good place to start. And I'm excited to be here. Thanks for having me. It's a very open-ended topic. And the presentation you're referring to, I posted on Twitter a few weeks ago after doing a talk at a university about it. I think picking an idea to work on is interesting because there's a lot of factors to consider and angles to consider. But a lot of times people just think about like one or two things. So they might think about like, well, what do I love doing? Or what am I good at? And I think those things are important, but I think there's other attributes to consider as well. You want to think about what you're good at. You do want to think about what you like. And then you also want to think about like, well, what does the world actually need? Where do people have budget or customers have budget? And like, what will they pay for? And maybe diving into each of those really briefly, what are you good at is something people think about a lot, because you do want it to be something that you have like a special advantage or strength in. That's a lot better than if it's something that everybody else could do. And then what do you like is also nice. Sometimes people don't think about it enough, actually. They think about their strengths and less about like their areas of passion or interest. But I think picking something you like is really important, because what happens is before you start a startup, maybe you read about it, but like it's hard to appreciate just how many ups and downs there are. The ups are really nice, but the downs can be pretty low. And I think if you work on something that you're not that passionate about, it can be pretty hard to get through like the trough periods without that like strong internal motivation. So I think that's a really important aspect. And in terms of like focusing on things the world needs, each of us can work on so many different things. I think it's better to work on something that actually matters and makes a difference, both for your personal satisfaction, but also that has like a really great implication on fundraising and hiring and getting customers and getting press. The more exciting your mission and the more ambitious it is and the more valuable it is, the easier it is to get other people on board. And then kind of related to that, you do want to pick something that people will pay for. Because if you make something great, but nobody wants it, or people want it, but they just can't afford it, your business won't work. You want something that is a viable and good business. And ideally, these are things you can stress test a little bit before you actually start a company around whatever idea you're thinking about.
All great points. I think we'll go into some of them during our talk. Because it's deep tech, a lot of my listeners and people I focus on are doing research during the PhD and postdocs, and that is what they're trying to translate. One thing you mentioned in there was many people say this, don't do it for the money. Maybe these people need some different message. They need to probably think about money because they probably never made a decent salary in their life during the grad school and postdocs. How do you think about money? How should one think about it in deep tech space?
I definitely don't see it as a sin. I mean, I would say, if anything, I think it's a good yardstick to figure out if you're creating something valuable. If you're measuring distance, you have like feet or meters or whatever. If you're creating value, like how do you measure it? And I think the measurement is like somebody will pay you for it. And the more they pay you for it, the more value you're creating implicitly. Somebody won't pay you $1 million if you give them $900,000 of value. Like, that's not a good deal. So I do think charging is important. I think it's also one of those things where the more successful your business, the more ambitious you can be, the more like revenue will fund ideas you want to pursue or being able to scale up or service more customers. So there's a lot of advantages there too, where again, the stronger the business, the more people you can serve and the more people you can help. And I think that's really enticing. The most common mistake on the business side in terms of pricing is probably charging based on cost. So it's like, oh, this cost me $1,000 to make, so I'm going to sell it for $1,100 or something like that, and then I get a profit. What you really want to do is you want to charge by value. How much is the customer value whatever you're making? For example, like you make, I don't know, electric car or something. So it's more efficient, it's greener. But for example, there's some customers that don't value that at all because maybe they don't care about the environment. They just care about how cool the car looks. Or maybe they drive like 1,000 miles a year. And so even if you save them half their gas costs, it's not that meaningful. There's other customers that really care because maybe there's regulatory pressure on them to have like a more efficient fleet, or they drive 80,000 miles a year or whatever, 50,000 miles a year. And so for them, even a small fuel savings is really valuable. You shouldn't charge those two groups the same amount. You should kind of charge based on like what value they're getting, not whatever it costs you plus a little bit of margin. So that's probably the biggest pricing lesson I can share.
We will dig deep into the pricing point. Can you elaborate more on the attributes of markets? I saw a slide on that. How should one think in the deep tech space?
People talk about market sizing a lot. And I think this is probably like from pressure from VCs. For a VC, what you're trying to back is an early stage company that you think has some shot of being $1 billion business. If you back into what does it mean to be $1 billion business, it probably means you can get to something like 100 million in revenue. And if you work backwards from that, very few companies get 100% market share. Part of the reason market size matters is if you have a huge market, let's say it's a $50 billion market, $100 million in revenue feels like very viable. It's not easy. It's like 500th of the customer base. If you have a $200 million market, you have to capture half the customers, and that's usually hard, if not impossible. And so that's where like market sizing comes into play. Investors, as a shorthand, really look for like 1 or 2 billion or bigger markets. Because again, that's sort of the size where even with decent market share, you can be $1 billion company, maybe you can even IPO. So that's sort of the level where like VC funding makes sense. And so there is that top level number. What's the size of this market? And what that means is like, what's the total revenue you'd have if you had 100% market share? But there's other things that matter. So some of it's how accessible are the customers. So sometimes, for example, the customers are all 20, 30-year friendship relationships with whoever's selling to them. And like, even with a better product, like maybe you just can't actually sell to any of them because they're not driven purely by rational factors. They want to keep their friend and their relationship intact. Or sometimes the market's really concentrated. So you have $1 billion market, but 90% of the market is like 3 companies. Well, if you can sell to those 3 companies, great. And if you can't, your market's actually a tenth of what you thought it was. One example that comes to mind there is like the space industry. If you look at something like satellites, SpaceX is probably like a giant portion of market share, and they build a lot of their own stuff. And so if you're building something that rocket providers or satellite launch providers want to buy, if you can sell to SpaceX, you have a pretty good business. Although honestly, they probably negotiate pretty hard with you knowing their power. And if you can't sell to them, your market's maybe pretty small. So you want to think about some of these other dynamics of how big are the customers? How spread out are they? Do they have a lot of collective power to negotiate with you? Do they have a lot of options for alternatives? So I think all of those things kind of matter. And you want ideally a market that's in your favor instead of like it's an uphill battle for you to succeed.
Thank you for elaborating on that market size subject. I think this is a good place to talk about Humba Ventures and your own focus on deep tech. I think you're a traditional venture capitalist and then moved on to Humba as to focus on deep tech. Talk about that journey and the decisions and more about the firm?
Maybe I'll do like a 15-second background on myself first.
Yes, please.
So graduated from Caltech with a computer science degree about 20 years ago. And then I spent about 10 years as a software engineer. Started my career at LinkedIn. I was fortunate enough to join there pretty early. So I was there from about a dozen people up to about 50 as one of the first software engineers. Then worked at Google, worked at another startup called Factual. And after about 10 years as an engineer, to go out to do next, I was actually thinking about being a founder and had some ideas in mind. But I got this opportunity to try out venture. I knew some people that were thinking about starting a venture fund. And I thought that would be a great thing to do because I could learn a little bit about how investors think, things that early stage startups do well or poorly. And I could learn from that and then go start my own company. Instead, I ended up just really loving the venture capital side. I started Susa Ventures, which is at this point, I would say like a relatively established and well-known seed fund about 11 years ago with the other partners. And Susa is very focused on traditional tech. So it's very B2B SaaS and healthcare and fintech and a lot of these sectors that VCs have been focused on for decades. But I've always, especially with a technical background, been eyeing these deep tech companies building in space or robotics or better energy solutions. And I've always been interested in those. And I think until a few years ago, I felt like those are hard sectors to invest in for an early stage investor because there was a decent amount of early stage capital, but not much afterwards. And a lot of these companies did need a bit more capital to get off the ground. And so there was kind of this weird dilemma where, you could like a company, you can give them some early funding. Our fund doesn't have enough deep pockets to like fund a company for 5 or 10 years, just for the first 1 or 2. But then if there's no follow-on investors at the next stage that'll fund these deep tech businesses, maybe because they're intimidating or hard to understand, a lot of those companies like just won't end up going anywhere because they're out of money. I think in the last couple of years that really started to change. So I started seeing a lot more investors at Series A and B leading rounds in these areas, getting more comfortable with these areas. There started being a lot more success stories like the SpaceXs of the world or like the Andurils of the world, where you could see here's a category that we didn't appreciate. And now there's a $10 billion, $100 billion company. And there's a bunch more that are like 500 million or billion or 2 billion. And so I think that also gave investors a lot more confidence to invest here. And additionally, I think those successful companies created a lot of talent that, eventually often spins out, starts their own companies, advises the next generation. So it kind of felt like it was easier to invest in this space because there's more follow-on funding and also easier to build in this space because there's more talent and playbooks to learn from. And started really focusing on this about 2.5 years ago with Humba Ventures. And the way we thought about it is Susa is really good at traditional investing. So invest in some great fintech companies and logistics companies like Robinhood and Flexport and Mox and many others. Don't have a lot of experience on the deep tech side and kind of wondered, like, should we carve out a little portion of the fund and tell people to do deep tech investing, but maybe they can tell that we're not that serious about it because we have a large fund with like a small carve out for these areas? Or should we set up a fund within the Susa Ventures family that just focuses on these areas? And we thought that would be a lot better, both for entrepreneurs and for the fund performance. And so we ended up splitting out the fund so that we have Susa and Humba Ventures under one roof. We also have an opportunity fund that does Series A's and B's. And Humba is just focused on deep tech. So it just does things like robotics, energy, some of these emerging, interesting sectors like defense and manufacturing. So I've been investing there for the last couple of years, done about 20 investments since then. Checks are usually about 500K. It's usually early stages and it's been a lot of fun. I think it's fun to like dig into the technology. And also a lot of these companies can have like a really huge impact because they're just working on such fundamental problems, and definitely feel very fortunate to be in this position.
Thank you for that background. It's a nice setup. Maybe before you go talk about other things, because you've been a traditional venture capitalist in the deep tech space, what differences do you see in your investments and thesis in these two categories?
I do think a lot of things carry over pretty well, but probably some of the biggest differences on the deep tech side, I think the team and the technology matter a lot more. For like a SaaS business or a fintech business, a lot of times what you're actually betting on is like the idea plus some go-to-market strategy, because there's often a lot of competition. And so the question of the founders and the company is like, well, how do you stand out in the sea of competitors and similar products? And usually you need kind of a different angle on how you get your customers, or maybe like what your value pitch is to customers. But the tech itself is not easy to build, but it's not super, super hard to build. On the deep tech side, it's almost the opposite, where a lot of times you're like, hey, if we could generate energy for half the price, would people be interested? And it's like, yeah, absolutely. You don't need to market that. That'll kind of sell itself. The hard thing is that can you actually generate energy for half the cost or do something else like that? The focus as an investor tends to be much more on the team and the technology and some of the alternatives. Is this actually like a viable thing? Does the team have the right background for it? I think also like maybe much harder to like self-teach yourself in the same way that you could, let's say, building a SaaS startup. So if you're building, I don't know, like rocket engines, maybe Elon Musk can with like tens of millions of dollars and years of time. but most people can't just pick it up on the fly after raising like a pre-seed round. So definitely much more focused on founder market fit. And then maybe a couple other things. The sales cycles tend to be longer. So companies usually need a little bit more time in the early days to get their first few customers. And then also, as I mentioned, the follow-on funding market is better now, and there's starting to be more grants and things like that. But it still can take a little bit more money and time in the early days. So I think being able to budget becomes a lot more important. Like a B2B company, maybe you have revenue within your first few months or first year. But for a deep tech company, you're probably at least a year and a half or two out most of the time before you get any revenue. And sometimes it's like 4 or 5 years out.
When you talk about timeframes, these are much longer timeframes, even just to hit the market and really make money. How did you evolve from your early stage? Because it takes a kind of an investor to take a risk and put money on these things, especially in the deep tech space. How do you think about those things? And the higher capital requirements too, like much higher than a SaaS company, for example.
I would say there's tiers of capital intensity. One way people sometimes divide deep tech is like, is it engineering risk or science risk? So science risk is like you're working on some fundamental scientific breakthrough and you're not sure if it'll work yet. Maybe you still have to like do a few things to figure out if it really works. And those companies often need a bit more capital. You're talking about things like nuclear fusion or something or quantum computing. And so those companies often need hundreds of millions or more in funding before they can be commercially ready. To be honest, those are hard for a fund of my size, so I generally just avoid them, even though I think they're really interesting. Then I think next step down is you have a little bit of science risk or maybe significant engineering risk in terms of assembling a lot of like complicated existing technologies together. Those companies might take 5 or 10 or 15 million to get to revenue, but I think these days that's pretty feasible. It's sort of a seed round, maybe plus like a Series A round. One example is like I work with a company that builds ASRSs or automated storage and retrieval systems, warehouses. So these are these giant metal grids where people store pallets and packages. They have robots or forklifts trying to put things in and take things out. That's a pretty big piece of infrastructure. You can't just go prototype it on like a couple $100,000. A company like that, they might need 10 or 20 million before they get to a place where they can sell something that works. But they don't need 100 million. They just need something like 10 or 20. And so probably half of the companies I invest in are kind of like that, where they probably won't have traction before a Series A, but they'll almost certainly have it before a Series B. And then the other half of the companies I invest in are, I'd say these tend to be more engineering risk than science risk. Mm-hmm. So it's like assembling technologies, and often you need like multiple skills. Maybe it's mechanical engineering and hardware engineering and software engineering. A lot of companies in that boat actually might be able to get some revenue with like the first 1 or 2 or 3 million in funding. There's one I work with, for example, called TreeSwift that does 3D forest mapping and surveys with drones and satellite imagery and sensors. The tech is pretty complex. They have robots and drones and sensors and satellite imagery, and they have to combine all this data and computer vision on it. It's not simple, and it's much more complex than a typical startup. But that said, like there's a real need for it. And the founders had a lot of great experience here. So they were able to get a little bit of commercial traction just in the first year and a half. And then now they kind of look like any other B2B company scaling in terms of revenue, even though, I put them much more in the deep tech category.
What I'm hearing is you're more on the engineering side of deep tech than the science.
Yeah, I'd say like I focus more on the engineering risk side. Most seed funds do as well. And then I think as you get into larger funds, they're sometimes willing to take on a little bit more of the science risk. This is a very simplistic way of saying it, but the more money you need to raise before you can start hitting revenue, the harder it is to do. You can convince somebody to give you the first couple $100K or a couple million with a great idea and maybe some validation from talking to customers, even though they're not paying you anything. It's much harder to raise $20 million off of a story. And it's much, much harder to raise $200 million off of a story and some progress, but still uncertainty about whether you can build a great business or not.
Great points on that. Since you are one of the leading investors in the seed stage, how do you prioritize when you decide to make an investment? Is there a framework that you use while evaluating a startup?
I wish I had a better answer. I do think it's a little bit like varies company to company. Some of the themes I like, especially on the deep tech side, are good founder market fit, meaning that the founder sort of understands the space they're building, the needs of the customer, even if you don't have customers yet. For example, like if you're trying to make some industrial scale battery, there's trade-offs there, right? There's cost, there's size, there's efficiency. And you can't just do that in a vacuum without understanding the space and maybe having worked in the space. And it's much better if you actually have experience with the industry. For example, customers prioritize space over everything or cost over everything. And this other thing is an afterthought. So I do like customers that have founder market fit, both on the business side, like I said, the industry knowledge, and the technology side. Maybe you're doing drones and robots for like forest surveys. Do you have experience with drones and robots? Because if not, maybe you can figure it out, but it's just going to be a much steeper climb. And so I like founders that have some relevant experience. And often it's across the team, it's not within one person. And then the other thing I like to see is just deliberate planning and decision making. There's so many directions you can go with the company. What's your first feature? Who's your first customer? Like, what do you think your first customer looks like? And I think the companies that tend to do better, they kind of think about a lot of the options. They think about the trade-offs. They try to do their best to prioritize given the information they have. And I think the companies that on average do less well, they fly by the seat of the pants, and sometimes it works and sometimes it doesn't. But I think that's a lot harder to bet on.
Founder market fit is a great space. Speaking of teams, is there anything that stands out in your investments when it comes to the communication skills or the collaboration they had that actually is a must, I think? Do they come to you with a single team member, or when they come with the team, what stood out in terms of communication skills? What can people work on actually?
I'd say like a few things stand out. I think one is, especially if there's multiple founders, ideally they're complementary and they work well together. And you can tell that they sort of understand and trust each other on the parts they're responsible for. And so what that means, for example, is let's say you're building a nuclear power plant. You don't want the founding team to just be like 4 nuclear engineers, no business experience, no energy industry experience, like they're just researchers in like this one space. You probably want some mix of this person knows the industry, and then this person knows how to build a reactor, and this person is maybe they optimize the materials for it. But people have, diverse and complementary skills. And then the second point is they trust each other. So you don't have the guy that knows the industry keeps talking over the guy that designs the power plant and kind of overriding him. Because I think that's sort of a recipe for like a founder breakup in the short term. I think the other thing that is nice to see is somebody can communicate with different stakeholders well, because you have this with employees and investors and customers, and people have different levels of knowledge. And so a lot of times during diligence, I'd say I'm probably more of a layperson on most things. I'm technical. I know a little bit about a lot of areas. I'm not super deep on anything. I'm sort of listening from a point of view of a layperson, but a lot of times I might try to get like an expert into the diligence process at some point to join me on a call. And so you can kind of see like, well, do they use like different words or different ways of describing things to different people, depending on the person's background and context? Do they use like super, super technical jargon with me? And then they don't perceive that I'm confused and not understanding things, and they just kind of steamroll. That's not a good sign. Or for example, if they're dumbing everything down for the PhD I brought to the call, that's also like not a good sign. I think deep tech specifically is very hard to communicate. And so you want people that have that ability, because they're going to have to do it a lot, even more than most companies.
They don't teach communication in terms of in grad schools and postdocs. There's a big, big drop. I wish they teach storytelling as a subject for all scientists, to everybody, I think. I agree with some of the points you mentioned. When it comes to teams, how do you work with them? What is your working style? Let's pick one topic like commercialization. What role do you play? Because they might be bringing the technology to you, might not have too much bandwidth in terms of the commercializing. How does Humba Ventures work and you work with them?
In working style, the goal is to be like helpful and accessible, but not invasive or meddlesome. And so usually what we'll try to do is a half-hour sync once a month, just so that we're up to date. We can get an update for a couple minutes during that half hour. And then if there's topics that the founder wants to chat through, or sometimes there's areas we can proactively see we can help with, we'll talk through those for 20, 30 minutes. So that's like the cornerstone to just like a good short monthly engagement. And then outside of that, always available by phone and email and things like that. So that's the cadence that works pretty well. In terms of something specific like commercialization, again, maybe not a satisfying answer, but it does depend team to team. For example, some teams, they have an amazing Rolodex, but they don't know how to sell. So in that case, maybe you're trying to coach them a little bit on like, here's some good sales strategies. Here's a book you should use. Here's like an advisor you should talk to that can coach you on doing a sales pitch well. Or maybe it's like, let's do a practice sales pitch and I'll give you some feedback. Sometimes it's the opposite. Like maybe somebody has amazing sales skills, but like they don't have connections in an industry they're selling to. And so there, the assistance might be more like, let me find you a co-investor or advisor that knows that space. Let me look at my network and my teammates' networks to see, like, do we know potential customers? So there, maybe it's more about connecting to the right people. Those are maybe like 2 flavors. Some of the things that come up frequently, you mentioned pricing. I think thinking through pricing and brainstorming through it is a pretty common and I think high leverage thing to work on. I think same thing on figuring out like what's the right ideal customer in the early days, because there's a lot of directions you go in, and then some customers will care a lot about what you're building and some won't. And if you target that second group, you're just going to waste a lot of time. And so kind of brainstorming around that, I think, is an area we like to spend a lot of time in as well.
Pricing came up a couple of times in our conversation already. I think Let's take a deep dive in that subject. If you have some stories of how the founders were thinking about a price point and how we were able to shape it and what the final outcome was, and general mistakes when it comes to pricing it in the deep tech space. It's hard. Like if I'm making a drug, if I'm going to sell it for $1 or $2 million, that is something that we don't think about. A lot of money goes in a small population that has that disease. Maybe take one or two verticals and talk about pricing and how one should think about it.
There's a lot of decent heuristics. For better or worse, like a pretty good one is just see what your competitors charge. And then that's a good starting point. Another one is to see what customers will pay for things like what you're offering if there's no direct comp. Let's say you're selling a tool for HR. Maybe there's no equivalent tool, but you can get a sense of what do customers pay for other HR tools. And if it's generally $25K a year, that's probably roughly what you can charge, give or take, with some exceptions. And if it's $10K a year for most tools and you're charging 100, that's going to be pretty tough to sell. Those are some of the really simple heuristics people use. I do think the biggest thing is like trying to understand customer value, which we talked about earlier, especially because on the deep tech side, value matters a lot and can change drastically. We talked a little about like, let's say I had a technology that makes your energy usage twice as efficient. It halves your energy costs. So if I go to somebody where they make a product, the product's low margin, 90% of their cost for the product is like energy input, they care a lot about saving half of that energy because that's going to just be huge for their business. If I talk to some other customer and they're like, well, I have huge margins on my product, maybe it's like a SaaS software product, energy is 0.5% of my costs. If I can cut it in half, like the customer just doesn't care. You shouldn't price things in the same way. You got to figure out like who's the customer that really values what you're building, because the more they value it, the more you can charge. Kind of related to that, you want to understand like, well, what's their equation? If I give this to them, how much will they save, or how much more revenue will they make, or how much less time will they need to do something? And then based on that, that's how you would price. One good rule of thumb is you can charge about 20-25% of what you save somebody or what revenue you create for somebody. If I sell you something and it's going to make you an extra 100 grand a year in profit, I can probably charge you like 25 or maybe 30 grand before you start being like, hey, Leo, you're being really greedy. At some point, like I could try charging 90%. And even though you'd still make 10 of savings, I think most people would walk away sort of out of bitterness because it just feels lopsided. But basically, you want to figure out what value you're creating from somebody and maybe take 20-25% of it as a starting point. I think the other interesting thing on pricing is your pricing scheme can be based on a lot of different things. So for example, it could be a flat fee where you're like, hey, this is $100,000 a year. Or it can be usage based where you say, well, every time you use an AWS server, it's $1 per hour. Or it could be seat based, which is like every employee you have using AWS pays $1,000 a year. And each of those has pros and cons. And again, you do want to sort of align it to like, how does the customer think about where they get value? So for example, if you charge per seat, what happens is people try to minimize the number of seats. That's how I save money. And so if a customer feels like, hey, every person that gets a seat here, they're going to do much better at their job, they'll just take the cost and pay $1,000 a person or whatever it costs. If the value to the company is not like that, like maybe the first person saves a bunch of money and then everyone else can just go to that person, ask them to use your tool, it's going to be really hard to charge per seat because the company's like, we'll just get one seat and share it. Or same thing with like usage based. Let's say you charge $1 per hour of compute. If somebody values every hour of compute at like $2, they'll happily pay you $1 for it. But if somebody's like, well, in some cases I value it as $2, but sometimes it's only worth 50 cents to me because it's like not an important project or something else, it's really hard to do that kind of like dollar pricing because customers start really scrutinizing like, well, where are they spending? Should they not use you for some things? And like, that's just a game you don't want to play. So again, you really want to think about how do you set the price so that it aligns with value, both in terms of how the customer makes money, how the customer perceives value, and then making sure that you're taking something that's a reasonable, fair cut, but not too excessive. And on the flip side, not too low.
It's a very hard subject, I'm sure, for everybody, especially for scientists, I think. I hear Mark Anderson talking about how you should price it really high because it can decrease the pricing, can never increase it. And that is a thought process or psychology that doesn't come to scientists or deep tech folks. And that's why I'm trying to hear out what people have been using.
I think those are interesting points. I'll give you like a few more anecdotes and tips that I found useful over the last few years. So first, in general, people tend to underprice a lot. I think this is deep tech and traditional tech. I think most people feel self-conscious or like guilty asking for more money. And I remember doing a survey a few years after Susa Ventures started of some of our portfolio companies. It was like a really short pricing survey. And the question was basically, what do you charge today for the same product that you had when you launched? How does that compare to what you charged when you launched? On average, I think companies charge something like 4 or 5x more today for the same product. And it wasn't necessarily that the product got better. It was more like everyone kind of underpriced by 80% on day one. And then it took them a while to figure out, hey, when I sell this to people and I tell them it's 5 grand or 20 grand and they immediately sign, maybe that means I'm undercharging. So I think that's one anecdote, right? Which is it's hard to internalize because even knowing this, people still underprice. But knowing that most people underprice by like 2, 3, 4, 5x, maybe that's a good starting point, right? Like whatever you're going to charge, like could you just double it? A heuristic related to that I've seen a lot of companies use is you have some price, you try that with your first few customers. If you don't get pushback, you don't have to change their price, but like go to the next set of customers and double it or like add 50%. Keep doing that until you get a lot of pushback. And sometimes you'd be surprised at how many times you could double it before you get pushback.
One of the mistakes I see, especially in the deep tech, I can talk about biotech, therapeutics, and tools spaces. These scientists who are building startups, they are very shy, scared of asking for money because if they don't want to pay, it's a rejection. So they end up doing free trials. I did a big mistake with my own startup where we ran a clinical trial at UC San Diego. We did the testing and everything for free. A lot of people get caught into it and then they kind of become a service provider for other people and don't make too much money. Any thoughts on how to avoid that? And how do you ask for money for your product?
I think this comes back a little bit to the earlier conversation around like, is it bad to ask for money? Part of asking is like, you're just trying to see who even cares. It's going to be a dumb analogy, but maybe you have like Hulu or Netflix or something. And if I was like, hey, do you want to add the ESPN racquetball package and it's free? You're like, sure, whatever. Like, I don't care. It's free. Like you can add it or not add it. I won't notice. If you're offering it for free, like, sure, maybe add it on. And if I was like, hey, would you pay me $10 a month for it? Unless you're a big fan of racquetball, you're probably like, no, like it's not worth it to me. And so the problem is if you offer it for free, it's almost like a vanity metric. You're like, look at all the people signing up for this racquetball channel. Clearly there's product market fit there. People really want this. When it's free, like you don't really know. I think when you start charging, that's when you see like who really wants it. And some of that's on the pilot side, which is if you tried charging and nobody will pay you, maybe you have to do a free pilot or two to like validate that your technology works. But a lot of times, if you're clever enough and kind of think about the industry enough, there's often some customer that wants what you're doing so badly that they will pay you kind of even while you're unproven, even for a test. And these pilots are often like pretty meaningful in size. Going back to like, if you offer a free channel, people just take it. If you ask like $1 billion company for like a $2,000 payment for a pilot, they don't care about $2,000. You want it to be something where, again, it's a little bit of a litmus test where if you go to like $10 billion companies and you say, this pilot's going to cost you 30 grand, you don't want that price to be so high that all of them say no, but you don't want it to be so low that all of them say yes. You want something where it's like, they can kind of self-select. Hey, here are the two that really care. They'll pay me 30 grand and those will be my first pilots. And then if those go well, hopefully they'll turn into customers. Ideally, you can kind of set that up or talk about that up front. So I'd say like that's one common thing with pilots is sometimes they're just open-ended. There's not really a milestone or target you're hitting. It's more like, we'll just pilot this and then hopefully it'll make you happy. Let's revisit every few months. What you really want is, hey, Naresh, you're the customer. My technology does X and there's some metrics around it. Let's do a pilot. It's going to cost you this much. And then what are the metrics you want to see to get you comfortable with the technology? And then once I hit those metrics, you'll pay me some pre-agreed upon amount. So like something like that works pretty well. And I think you have to remember too, is you're asking the company and you're providing a benefit. Don't feel guilty. You're not saying like, hey, will you donate 100 grand to me? You're saying, hey, will you give me 100 grand because I think I could provide 500 grand of value to you. And I think that's actually like great for both sides.
That's a great way of pitching to a potential customer. A related question, market sizing. Some of these markets are like so far into the future that founders have to paint a beautiful rosy picture of like how the future is going to be, and an understanding of pricing is going to be important as well. And venture capitalists, most of them don't want to touch a startup if it's less than $1 billion market. How should one think about it in terms of painting that picture? I was just reading something by Andy Chen from A16Z today morning about painting beautiful pictures. How do you frame everything and tell a good story in terms of market size?
The smaller the market, the harder it is to tell the story. A few things that help is, one is, to your point, market growth rates. If something is 200 million, but it's doubling every year, I can do the math. In 5 years, it's going to be worth $3 billion or something. That's pretty good. And so if people believe in the growth, they might invest in a smaller market. The other technique is you could look at adjacent things where it's like, well, this market we're pursuing is $300 million, but here's 6 other ones that could use similar technology. And they're also each $300 million or $500 million. So when you add them up, it's a great market. So I think things like that can help. The key things to nail in the story is like you want it to be compelling. If somebody believes your process, then the conclusion is one where they're excited about the market and the market size and like investing. And I think the other part is not just compelling, but it has to be like believable, because I can be like, here's $1,000 market and it's 10xing every year and it's going to do that for 10 more years. No one's going to believe that. That's not how things grow. So ideally you have some supporting data. So for example, maybe it's like, hey, in the last 3 years, this market grew from 50 to 100 to 200. The estimate is this year it'll be like 375. And so if you just extrapolate that by a couple of years, and even if you're wrong, maybe like 4 years instead of 2 years, it's a great market. That's a pretty believable story. And then the other thing is you can make up for this in other ways. You could think of an investor as they have a bunch of heuristics on the team, the idea, the market size, the profitability of the business, the competition. And you can be weaker in some of these if you're stronger in others, because nobody expects perfection, especially the early days. So it might be that, well, maybe your market is smaller, but you have no competition. You could build a monopoly. Instead of being one of 20 companies going after a $10 billion market, you're like one of one company that's going after a $500 million market. Or maybe you have like some special access to early customers. And so you can get to revenue very quickly. You don't need to raise a lot of money down the road. That's maybe a little bit easier for a seed investor. I'm okay with a smaller market, but I know like the Series A guy won't be. If you can convince me that you probably don't need a Series A, that's kind of an interesting pitch. You definitely don't want to lie. You want to make it as compelling a database as possible, but also you could make up for in other places potentially.
Great advice on that. Leo, I think you're one of the very few investors who actually sit down and give advice. And in terms of like when I come to pitch you, that's my first experience. It was helpful. On that note, is there an advice that works every time or majority of the time that people need? Any thoughts on your feedback?
I think one piece of advice that's basically always good is just to manage your burn carefully, how much you're spending. Basically, like each subsequent round you raise is harder and harder to raise because you need to hit more and more milestones. Kind of in parallel to that, every round of funding you raise gives you some amount of resources. This is kind of a crude way to think about it, but maybe it's like, hey, if you raise $2 million, it's 100 person months of effort that you could fund with that, plus maybe some other costs. If you ramp spending really quickly and you're like, let me get a team of 10 going right away, even though maybe I don't need 5 of those people for 4 or 5 months, you're going to burn through the months that you can afford very quickly. You had 100 person months, you just burned 20 for no reason because you hired people earlier than you needed them. You just cut your runway by 20%. And so I think just being very methodical and deliberate on when do we really need the next hire, and then you try to find them like a month or two beforehand because the interviewing takes a little bit, but you don't hire somebody today in January or February if you don't really need what they're doing until like December. I think burn management is probably the easiest to control piece. You have the cash and you control the hiring plan, so it's like fully within your control. But I think it's one place where sometimes companies spend too fast out the gate. By the time you correct it, it's sometimes too late, or sometimes it's not too late, but like it just really hurts you down the line. The piece of advice is probably hardest for a lot of founders to follow, especially in these areas, but in general, is especially if you're a CEO, you often have to let go of the stuff you really like doing. You come from research, or like I was working on robotics, or like working with like cells in the lab. If your company's like 200 people, you're not in the lab doing experiments anymore. You have people under you and people under them to do that. And so the problem is like sometimes people don't want to let go of that because it's like the part they find the most joy in. I like working in the lab or tinkering with the robot. Maybe it's even like talking to customers if you're more on the sales side. But a lot of times, like as the company grows, it becomes a bottleneck if the CEO or CTO is like writing code. They're really busy with other stuff. And like if they're busy, this whole project gets delayed by a week because everyone's waiting on the CTO, for example. I think like being able to manage your time, kind of evolve your role as the company needs it. I think that's probably like one of the hardest things for people to do that I've seen.
That's a problem definitely with the scientists and engineers coming from research backgrounds. They can't let go of it.
It was a challenge for me when I started Venture, because when I started, like I came from engineering.
You're
so
coding.
I was really excited to dig into like tech and be like, hey, let's do like a code architecture review, or like, let's talk about the algorithm we're using. And found out pretty quickly, it was just like, it was not a good use of time in terms of actually like helping decide what companies to invest in. And so even though I enjoyed it, sometimes maybe the founders enjoyed it, sometimes maybe they thought it was heavy-handed or something. But I could see like it wasn't providing a lot of value. And so even though it was like one of my favorite parts, over time, I basically started focusing on other things. That was what made more sense to the venture fund business.
In terms of evolution of these leaders, of the founders, what have you found that worked for those who scaled well and who didn't scale well? I ask this question just so people can have a mental note of things not to do.
calibrating on talent is important. I'm a software engineer, right? If you ask me to hire a software engineer, I'm like, cool, I can assess them. I've done a lot of interviews. That's easy or easy enough. If you're like hire a marketer or like a PR person, I'm just like, oh, I don't know what to start. Like, let me Google some questions. And then what'll happen is I'll get a bunch of candidates. I'll interview like 3 or 4 or 5. I'll pick one. I'll be like, cool, like they seem pretty good. Are they pretty good? Or like, was my pool of candidates crappy? Or maybe I looked for the wrong thing when making a hire. And so I think one thing that really helps is ask your friends, ask your investors, ask your other founders. For example, for PR, like who's the best PR person you know? And just try to talk to a couple of those people for just like 15, 20, 30 minutes. Try to figure out like what makes them so good. What would they look for if they were looking for a PR person? And then when you're interviewing, you can really tell like, hey, is this actually an A+ person? Or did I think they were an A+, but really they're like a B-? I just don't understand the domain very well. I think calibration is important. Learning to delegate a little bit. Again, it comes back to like stepping back from the parts you love, which might be more like in the details. But you go from early days, you're maybe doing some of the work and managing people. Then you're managing people that do the work. Then you're like managing managers that do the work. So you kind of go up and up on levels of abstraction. And so I think just getting comfortable with that and embracing it and really just trying to find the best leaders between you and the people doing work that you can trust, you can give autonomy to, they'll report to you and you could kind of help with strategic decisions, but you're more high level. I think that's really important as well.
Calibration and delegation, I think it's super, super important.
One other one. I think there's actually another big challenge for founders, managers, investors. When you have like an A player, it's very easy to keep them. And when you have a C player, it's very easy to decide like you want to let them go. The Bs and B pluses are very tough. They're not amazing, but they're not bad. They're just good enough to keep on the team. What I've seen is like the founders that go further, they tend to be pretty fast and ruthless, still empathetic, but like very methodical. In terms of like, hey, if this person doesn't meet a certain bar, we'll part ways, we'll give them a nice severance and we'll try to find somebody that meets that bar. Because I do think that helps keep the execution and the speed and the caliber of company higher. If you just stick to the A players and then the B players, you don't keep them around for years trying to see if they get to an A eventually.
I think it has to be etched into the ethos of the company from the beginning that if you're not conscious, it'll be filled with a lot of B and B pluses.
It's one of those funny things because I think there's advice that's easy to internalize and advice that's hard to internalize. Pricing, where I said most people underprice, even when you tell them most people underprice, they still underprice. I think firing is the other one where even when knowing that almost everyone waits too long to make their like first fire, when I work with a founder and they're debating it and they'll debate it with themselves, with me for months of like, should we do this? Should we not do it? And at some point they decide, okay, like I'm going to go let this person go. And we ask them in a month, they're like, oh man, the company's working so much better. Morale's higher. I wish I'd done this like 6 months ago. I basically never hear anyone say like, I wish I hadn't done it. It's always, I wish I'd done it earlier. But even knowing that, like everyone waits too long on the first couple of times.
It's hard to internalize. I think I'm going through that one with my current startup with the pricing, and I'm trying to convince my co-founder that we need to price high, otherwise it's going to be hard. Moving along, I'll slightly shift the gears and talk more about your investment styles. And I think being a venture capitalist is super exciting because you get to learn a lot. How do you keep up with this ever-evolving technology landscape before you make an investment?
It's the most fun part and also the most difficult part, just because, like you said, there's so much stuff to keep track of. In my case, actually, I really like just meeting founders and learning from them and what their businesses are. Obviously, the goal of that is to invest. I end up making about one investment a month on average. Over time, you sort of built this one puzzle piece at a time. You built a little bit of an understanding of certain industries if you meet more than one company in those industries. Batteries are one example where I'd never looked at a battery company until maybe like 6 months ago. And then for whatever reason, I think in the last 6 months, I probably looked like at like 15 different aspects of batteries. I've learned all these random things now where the first time I asked a bunch of dumb questions, second time I asked like a bunch of dumb questions, like 1 or 2 smart ones. And then now it's like, oh, I can ask like pretty good questions because I'm still not an expert, but I now know a lot more through just talking to a lot of founders. I think that's probably the technique that's worked best for me. Looking at Twitter and news articles and Hacker News, like all of those things are good too, but they're probably more serendipitous versus targeted. I'm rarely sitting there and being like, let me just go read about batteries for 8 hours. I learned a little bit here. I learned a little bit there. I saw this article on Hacker News. I read it. I read some of the comments on it. And then over, a year or something, that adds up to like an interesting amount of knowledge.
Are there any specific industries within deep tech that you find particularly promising or intriguing for future investments?
I think robotics is actually pretty interesting. It's kind of an interesting area because I feel like there have been some decent exits in the space in the last 10, 20 years, but actually not a lot of big ones, a lot of medium exits. If you think about like billion-dollar plus robotics companies, like there's not that many. I think most of them have been on the surgical robotics side. On the flip side, when you go on Twitter or YouTube or like read some of these stories about what robots can do today, it's like really amazing. The demo made the rounds a few months ago was Stanford has this like Aloha robot, ALOHA. And if you search YouTube for their demo, there's like a 5 or 10 minute demo of it folds clothes and like flips eggs. And it's a general purpose robot. They didn't program it for 3 years to like flip an egg and now it can do it. You can give it a few examples with a human and then it learns and it doesn't need a lot of examples. So there's still like things to figure out there. You probably want better dexterity. You probably want it to learn in 1 or 2 examples instead of 10. And then ideally, maybe you want it to learn from Naresh taught it to like flip an egg. And so now Leo doesn't have to. So there's a lot of stuff that I think you'd want to build out for those to be really, really practical. But it's not hard to see this line of maybe in 5 years, maybe in 10, maybe in 15, you kind of have this Jetson style assistant robot where they can do some basic cooking or they can put the laundry from the washer or dryer, take it out, fold it, all the stuff that I think a lot of us spend a lot of time doing. And it's like instead we could focus on spending more time with family or work or things like that. And so I'm especially excited for that area of multi-purpose, very capable robots that can be trained to do almost anything.
It wouldn't be amazing where it's an open source robot, a different person comes and teaches it different things because it has the bandwidth and the compute power. One teaches laundry, one teaches cooking.
It's almost like the robot version of MOOCs.
Yeah.
MOOCs are like, hey, what if you had like the best algorithms professor teach algorithms aligned to everyone? And this might be similar. It's like, well, what if somebody's really good at cooking eggs? They could teach the robot to cook eggs and then it can cook really well for everyone.
Robotics is very, very interesting. On the subject of investments, are there any lessons learned from maybe mistakes you made investing in deep tech? And how has it influenced your current investment strategy?
To be frank, I've been investing in this space for like a couple of years. And so it's probably a little too short to like really have mistakes, which is not to say I've only made amazing decisions. More like I think it takes 5 or 10 years to see how companies play out. And I've actually got some anecdotes on this from the Susa side where we've had companies where typical time to raise a Series A from a seed is like a year or two. For this company or that, it's been like 3 years or 4 years. And you're like, oh, they're probably not going to make it. The founders are good and they're working hard. They just haven't figured it out. And like something clicks and they figure it out. And then 5 years later, they have a great company. So I suspect I'll see the same thing on the deep tech side. A lot of the companies in the portfolio seem like they're doing well. Some seem like they maybe are like going a little bit slower than planned. I think I probably need to play that out for like 2, 3 more years or maybe 5 years to like really see how that pans out. Probably the biggest mistake we've made, and I don't know if this is useful to your audience, but we were focused on like valuations and price a few times where we felt like a company was really, really special, but the valuation for it ended up being like 2 or 3 times what we thought it should be. So we ended up passing. And then we have a couple examples like that where those companies are now like $5 or $10 billion businesses. And so now investing at a $25 million valuation instead of 8, when the company's 10 billion, either one of those would have been a great price. So I think that's one lesson we've learned. I think maybe in the early days, I overvalued serial founder ability a lot. I think there is value there. I think I used to think, a serial founder is going to be like 3 times more effective than a first time founder. It's probably more like 15 or 20%. There's a difference there. But what happens is like people, they've learned from a lot of their mistakes from their first company or first couple of companies, but they maybe overlearned and like now they overcompensate in some areas. There's sort of like advantages and drawbacks. Maybe that's another area where like I've started to like watch myself a little bit more.
Valuation is another tough subject. Any thoughts on that for founders for investability's sake? Investors, I think, want it lower. And the opposite goes for the founders. How should one think about it and reach a sweet spot?
A lot of times founders don't have a lot of options. If you have like 5 offers from investors, you can use them to negotiate against each other. If you have like 1 offer, you can kind of negotiate a little bit, but it's like take it or leave it. So with that caveat aside, I think in general, starting out with less is probably a good strategy in that it's easier to go raise 1 million than 2 or 2 million than 4 or 4 million than 10. And the higher you go, the harder it gets. But also counterintuitively, sometimes starting lower helps you get a bigger round eventually if you do get competition from investors. And what I mean by that is, let's say you go out to raise like $1.5 million and it's an attractive smaller round size and you get like 3 investors interested and they all give you a term sheet. Maybe you can negotiate that $1.5 million into like 2 or 2.5 and get a couple of investors involved instead of 1. And maybe on the flip side, if you had just gone out for 2.5 or 3 from day 1, everyone would be like, oh, it's probably going to be a little too expensive for me. I'm just going to pass. So sometimes it's nice to start a little bit lower instead of really aggressive. I think the other thing is you want to think about less about valuation, more like what do you need to like get to a meaningful set of milestones. Let's say you have some big validation data you need for your like therapeutic. You think it'll cost you like $3 million to get that data. You don't want to raise like 2.5 because that's like the worst thing you could do, right? Like you did most of your experiment. You have no progress to show for it because you don't have the data yet. And then you need to go out to raise again. What you want is you have some good milestones in mind. You have some maybe timeline and budget for that. And like, what kind of team do you need? And then maybe add like 20, 30% cushion. So in that therapeutic example, maybe instead of 3, you're trying to raise 3.5 or 4. That's usually a good place. Gives you some cushion where like if you have a setback for a month or 2 or 3, it's okay. We also have enough time to get to something meaningful. When you get to like the next level, let's say you get this validation data or you have some first customers or something, that's usually when you can raise more at a higher valuation. And essentially you repeat the process. Start with a reasonable ask, go to a lot of people, and then the more interest you get, the more you can negotiate that into a better offer.
Great advice. I know we're coming to the end for the conversation. Any specific advice for founders trying to pitch you or investors in general? We'll start with you first.
Like I said, I think one of the founder qualities I like is founders that are deliberate and really like thought behind why they're making a certain decision instead of another one. So it's probably like an area that I tend to ask a lot about. Because somebody will say like, here's our initial customer, here's the geography we're going after, here's our price. And, you know, a lot of times we'll just be like, well, like, why'd you pick that? Like, why not this other thing? And so I'd say like, maybe for me, it's like preparing for questions like that. And I don't know if there is a good way to prepare for that other than just like trying to be deliberate with your decision making. For me and investors in general, understanding your audience is like a good thing to keep in mind. I'm rusty, but technical. But then, for example, there's like bio PhDs that are investors. And then there's people that majored in, I don't know, European history, investing in biotech. For each of those audiences, like maybe you have a different level of technical detail you go into. Maybe you use simplified analogies for some of them and not others. So just thinking about for this person, what do I think is going to be the thing that gets them excited? You do want to try to find a couple nuggets where people are like, oh, this feels really unique and special and exciting, instead of being like, hey, we're sort of a B+ across a lot of dimensions, but we're not exceptional in any dimension. Ideally, your story kind of highlights the things you're exceptional at.
Before you end the show, are there topics that we haven't covered regarding Humba Ventures that people should know?
Nothing really comes to mind, but it's a really fun topic. I've done a number of these podcasts that are general business oriented. I think this might be my first one that's more like deep tech focused. So a lot of fun.
Cool. All right. I will provide some links in our show notes about how to reach you and your website and so on. But thank you so much, Leo. This has been fun. I'm always learning.
Thanks. It was a blast. You asked great questions.
Excellent. Thank you.
Thank you for listening to this episode of the Lab to Startup podcast. You can find links to the resources and programs mentioned in these episodes, connect with Naresh, or subscribe to this show at labtostartup.com.